If I can give you one piece of advice, don't forget that. Don't forget that everything you do towards your investments, every time you're working on your investments, you need to be answering those two questions. If you're doing something that doesn't answer one of those two questions, then you need to stop doing it and go back to focusing on these questions. So I think most people understand that investing is something that the rich do in order to grow their money into more money, but often people don't know how they can do it effectively for themselves. And this is a problem because compounding your money over the long term is an essential part of building wealth for when you want to have a family and eventually when you want to retire. So in this video, I'm going to explain to you what value investing is for beginners out there and how you can use it effectively in order to compound your wealth over the long term. Welcome back to the channel. My name is Hamish Hodder, and if you enjoy the video, please leave a like. But for now, let's just get straight into it. So I just want to start by first briefly explaining the concept of compound interest, because this may be a foreign concept for many people, or you may have heard of it, but you don't quite understand how it works and how the stock market can be an effective way of compounding your money. So compound interest is essentially where you let your interest earn interest on itself. So the best way for me to sort of explain this to you is think about your savings account. So in your savings account, maybe you're earning 1% interest, and every month or however often you get paid interest, you will see there'll be a few dollars of interest that gets paid into that account. Now, if you take that interest out and then you just leave the savings account as it is, then when the next month rolls over, you're going to get the exact same amount of interest paid into your account as you did in the previous month. However, if you leave that interest in there, then not only is all of your money going to be earning interest, that little bit of interest that is in the account now will also earn 1% on itself. And that is compound interest. And at the start, those couple of dollars that are earning interest, it's very small. But over time, it is an exponential effect. And over the long term, compounding your money can mean that it grows into a much larger amount of money very, very quickly. And the stock market is another way that you can compound your money, because of course, compounding your money at 1 or 2% in a savings account is not very effective, especially when that cash is losing value, losing purchasing power at 1 to 2% to inflation. So another way that you can compound your money over the long term is by buying businesses. And businesses are essentially cash machines. They produce profit, which you can think of as the interest in your savings account, and they reinvest it into the business to grow and expand the business to make it more profitable. And then in the next year, that business will produce more profit, and it can reinvest more of that bigger pile of profit into increasing the size of the business even bigger. And it's the same as your savings account, except it's going to be compounding your money, if it's a great business, at a much higher rate. For many great businesses out there, they're able to compound their money within the business at a rate of between 10 and 20% per year, which is a lot better than the 1 to 2% you can get in your savings account. And you can take advantage of this by being a shareholder. By buying stock, you become a part owner in that business, which means that you have part ownership of the profits that cash machine produces. And when it reinvests those profits will compound over time, and therefore your wealth as a part owner of that business will also compound over time. So the next logical question is, how do you make money? How do you compound your money in a stock? So when you buy a stock, there is two ways that you're going to get money back from that stock. And you should always think of stock market investments as two processes: an outflow of money when you buy it, and inflows of money that you are receiving as a return. And there is two types of inflows that you will receive. The first one is when you sell the stock for more. So the stock could go up in value. And the reason that the stock will go up in price over the long term is because the value of the underlying business, the business that you own while holding that stock, is also going up over time. And why would the value of a business go up? Well, it's producing more profit for its owners. So as I explained earlier, they can take their profit and reinvest it to grow the size of the business and therefore grow the profitability and increase how much profit is produced in the business. And that increased level of profitability means that people in the stock market want to pay more for that business because it's now producing more profit. And that will push the stock price up, and maybe 10, 20 years down the road, or even a shorter period, depending on what kind of investor you want to be, you can sell that business, that stock, for a higher price. And the difference between your outflow when you buy it and the inflow when you sell it is of course going to be one way that you can profit and generate a return from your stock market investments. But there is a second way that you can make money from your stocks, and that is what's called a dividend. So when you outflow your money, you get back a stock. So you put money out, you pay for the stock, and you get part ownership in that business. And some businesses, when they generate a profit, they choose to pay out some of those profits directly to its owners, which is you as a shareholder. So when profit is generated by a business, the management that is running that business, the CEO and the board of directors, those people, they make a decision. They decide how much they're going to reinvest to grow the value of the business, which, as we explained earlier, will increase profitability and increase the price of shares. But they also decide if they're going to just pay some of that profit directly to you in a cash dividend. So what that would mean is, while you're holding the stock, if the company is deciding to pay a dividend, then maybe every quarter or every half year or every year, you will receive a cash payment directly into your bank account. So those are the two ways that you can make profit, or you get inflows from a business, from the stock price going up and you selling it, and from you receiving dividend cash payments directly while you hold the business over the lifetime of that investment. So now that we've got that out of the way, let's talk about value investing specifically. What is value investing? So traditionally, value investing is generally classified as investing in businesses that are slow growers. They don't really change over time. They generate similar amounts of profit year to year over the very long term. And they're able to be bought at a low price relative to their earnings. So, for example, you might have heard of the PE ratio, which is something where it tells you the difference between the price you're paying and the profits of that company. So if you're paying $100 per share for that stock, and it's generating $10 per share in earnings, then you're paying a price to earnings of 10. And traditionally speaking, value investing has been paying the lowest price to earnings that you can for businesses so that you can generate the highest yield on those investments. But I don't think of value investing in that way at all. In fact, I think of it completely differently. I think of it as simply buying businesses, whether they're slow growers or fast growers, at a price that makes sense. And by price that makes sense, I mean you buy them at a price where you're highly confident that, one, you're going to get your initial investment back. Whatever you put out, you're going to get that back. And you're also highly confident that you're going to make a satisfactory return, that you're going to make a return that you're very happy with, and you're highly confident that you're going to receive that return. I call these types of investments low risk, high return investments, and essentially they're exactly what they sound like. There's very low risk, you're very likely going to make a satisfactory return, and more than likely, you're going to make an above satisfactory return, a return that is considered high compared to the market average. So how do we do this? How do you start value investing? Well, there's really two main questions that you should be asking. And these are the only two questions that you need to ask. It's, is it a great business? And how much am I paying for it? What am I getting back from this stock? So to answer these questions, there's really four major steps that you should be taking. And there's three major steps to answer the first question. And then there's one major step that answers the second major question. So the first part is we need to identify whether or not it's a great business. And the first sort of key attribute of a great business is that they have a unique competitive advantage. So this is something that is unique to the specific business that is somehow giving it an advantage over the other businesses in its industry. The example that I always use is Google. If you think of Google's search engine, you can think of the fact that because so many people use it, and because people talk about sort of internet searching as Googling something, if you ever need to search something, someone will say to you, go ahead and Google it, then the fact that it's so ingrained in people's minds that Googling something is searching it on the web, that gives them a huge advantage over other search engine companies. Now, of course, Google is a much broader business with other areas, but just focusing on that search engine part of their business, they have a huge advantage over the other search engines, and it means that it's very difficult for other companies to compete against them in that marketplace. The second characteristic of a great business is that it's run by great people. It has great management, great CEOs, great CFOs, great board of directors. And by great, we essentially mean that they're skillful, so they're very good at their job, they're very good at taking those profits, as we were talking about, and deciding where to put it so that it grows into even more, the maximum amount of more profit. But they also need to be honest and transparent. They need integrity, because naturally there's going to be problems that arise in every business if you're holding them over the long term. So we need to be sure that management is going to be honest and upfront with us, telling us what is happening when it's happening, so that we know, so that we can decide whether or not we want to continue holding the stock as an investor, or whether or not we need to let that stock go. And the last characteristic isn't really a characteristic of the business, but it's more about the investor, about you as an investor, and it's whether or not you understand the business. So you need to be able to understand the business, and the best way for you to do this, because you're probably not that sort of knowledgeable in particular industries when you're just starting out, you just need to invest in industries that you find really interesting. And what that means is, as you're investing in that industry over 10, 20, 30 years, over your lifetime, your understanding of how businesses work in that industry will accumulate. It'll compound itself. The knowledge will compound itself. And that means that you will have a thorough understanding of that industry, and it means you will be able to accurately work out which companies have competitive advantages, what great managements look like in those types of businesses, and whether or not they're going to be successful over the long term. And those three characteristics will help us to answer that first question: is it a great business? And once we've worked out that it's a great business, we then need to answer the other question, which is, what is the right price to pay? How much am I going to get back from this? Because ultimately, you're going to pay a certain amount for a stock, and you're going to get back a certain amount through the stock price going up and through the dividend payments. And the difference between your outflow and those inflows is going to be your profit, your return. So you want to make sure that you're maximizing your return, which means that we need to calculate what those inflows are going to be. And then from that, we can decide how much we want to outflow. So for example, if we work out that a company is going to be able to return to us $100 over the next 10 years. So maybe that's $80 when we sell it. We're going to be able to sell it for $80. And then maybe there's an extra $20 of dividends that are going to be paid throughout those 10 years. So that would be $100 back. Well, then from that, we can decide, what do we want to pay for that? We, of course, wouldn't want to pay more than $100 because that wouldn't make any sense. Why would we pay $110 to get $100 back over the next 10 years? But we also probably wouldn't want to pay $90 because that's not that good either. We would probably want to pay something closer to $40 to $50 so that we are highly confident that we're going to at least get double our money back over the next 10 years. And if the company performs even better than we expect, then we're going to make even more than that over the next 10 years. Generally speaking, I'm looking to conservatively get back between 4 to 8 times my money over the next 10 years. So that means that if I was to invest $10,000 in a business, I would want to be highly confident that I'm going to get back between $40,000 and $80,000 over the next 10 years. And these types of businesses are rare, but they do come up. And when they do, I absolutely maximize my capitalization on them. I put all my money behind them, behind a few great businesses, and I make a lot of money in them. And just to summarize this, those two questions that I was speaking about earlier, finding, is it a great business and how much should I pay for it? Those are the only two questions that matter to you as an investor ever. Ever. Not just as a beginner, ever. And you please don't, if I can give you one piece of advice, don't forget that. Don't forget that everything you do towards your investments, every time you're working on your investments, you need to be answering those two questions. If you're doing something that doesn't answer one of those two questions, then you need to stop doing it and go back to focusing on these questions. The questions don't change, you just get better at answering them. So instead of just focusing broadly on what's a great business, it might have a competitive advantage, management looks okay, and I kind of understand it. You don't change the question, you just get better at answering it. So you will have a better understanding of the industries, you will know them better because you've been looking in those industries for many years. You will have better ways of understanding what makes a great management. You'll be able to assess how much they're getting paid. You'll be able to assess how much stock they're buying or how much stock they hold, and and how they speak in the letters to the shareholders and how they speak on conference calls, and how these things impact how you feel about the integrity of the business and what numbers you can look at to see how skillful they are as investors. But ultimately, you're still answering those two questions. Is it a great business? And how much am I willing to pay for it based on how much cash I'm going to get back? And if you can stick to answering those two questions, and you can just dive deep and learn everything about how to answer those two questions, then you will do very, very well as a value investor over the long term. So I hope this video was helpful for you. And if it was, please leave a like and feel free to become a subscriber and join the team. We make videos like this all the time. So join the team and hit subscribe. And of course, if you don't want to miss out on any notifications, then hit that notification bell. But thanks for everyone for watching. I hope you enjoyed this one, and I'll see you guys in the next video.